And of course, I'll go ahead and introduce the Rockstar panel. We have Alexandra Gazer of Strive. We have Daniel Bunn from the Tax Foundation, and of course, Ryan Whiting from Vantage Risk. So let's go ahead and get started. This question is going to go to Alexandra. So reflecting on your tenure in the U.S. Department of Treasury and your legal background, how do you evaluate the political climate, particularly as it relates to regulatory frameworks, fostering or hindering foreign investment in the financial sector?
Yeah, thanks. So I think obviously, Latin America is a gigantic region, and the regulatory structures, the political climates there are going to be quite varied and diverse. And so I think, it's been alluded to, it's a big election year here in the US, and we are, I think, very accustomed to talking about political polarization, red states, blue states, that, Texas versus California has huge implications for your business. That is actually also true in Latin America, and I think true kind of globally as well. And so I would sort of take, two maybe broader points that are probably more depressing, and then two smaller specific points of light. So here, obviously, the US is the biggest, closest neighbor to the entire Latin American region. And so we would expect our policies to have an outsized impact on countries in that region, and they do. So this was alluded to in the last panel, but the relaxing, is sort of putting it mildly, the relaxing of immigration policies by the Biden administration have had huge effects on the US-Mexico border. And we would expect that with the large inflow of people up through various parts of Latin America, that's going to have an effect, right? So whether that's a deterioration in the rule of law, an increase in drugs, human trafficking, other illicit behaviors, even just simple disruption. I mean, when you're talking about hundreds of thousands, millions of people coming in and out, that really destabilizes economies. And so whatever your views on immigration policy in the US happen to be, I think you also have to take a critical eye and look southward and see what the effects of those policies are, sort of literally and figuratively downstream. The second piece, another not great moment of American foreign policy, has been with respect to Venezuela. And so, again, kind of whatever your views on the merits are here, we have had a lot of unilateral sanctions relief sort of before, during, and after the Barbados Accords. We've gotten very little in exchange for it. And while the Biden administration has been very concerned about helping Ukraine in its fight against a sort of land-grabbing autocrat, there's not a lot of concern for Guyana in its fight against a would-be land-grabbing autocrat. In fact, we've done a lot to support the land-grabbing autocrat there. So that, again, I think is not helpful policy in the region. Two bright spots, quickly, which I think we'll get to a little bit later. One is Bukele in El Salvador. He is really proof that you actually can turn your crime stats around. And an issue kind of near and dear to my heart, he is a real pioneer in terms of Bitcoin. He's authorized it as legal tender alongside the US dollar in El Salvador. I think it's really innovative and excited to see where it goes. And the other spot he's been mentioned earlier is Milei in Argentina. And again, he's got this sort of throwback, like, gee whiz, what if we improved the economy by cutting government spending and bloat and deregulating some things, and said so at Davos. And the IMF said, gee, that sounds great, right? Which is not usually who you think is going to cheer there. So there are some really bright spots in the region.
Now, Alexandra, I appreciate that. So in that same vein, I want to pivot to Ryan and talk about political risk, right? Because our topic here is global political risk and doing business in Latin America. So as a pricing actuary, specializing in political risk and credit, how do you assess the challenges of quantifying and insuring against political risk in Latin America compared to other regions?
Yeah, so I'll take it in three steps. So one, I want to give the audience some context for the product, what it is. I'll talk about pricing specifically, and then I'll sort of reframe it in the Latin American sense. So Advantage, our clients are multinational banks, multilaterals, development finance institutions, traders throughout the world. And the purpose of the product is to support and enable trade investment, particularly in emerging markets where political risk and credit risks can be perceived to be heightened. We see a lot of activity in Europe, Asia, and we're trying to do more in Latin America as well. On pricing and quantifying the risk, I like to sort of think about it as an art and a science. It's a science, so I'm an actuary, so it's a science in the sense that from an actuarial perspective, we have to consider what is the exposure, right? How large is the risk? Then we have to consider how likely is that risk to occur? How likely are we going to see a claim? And the third thing is, if a claim occurs, how severe is it? And political risk and credit in market is a low frequency, high severity product. On the art side of it, though, is there's not a lot of credible claims data. And particularly the case in Latin America, claims are infrequent, and a lot of claims haven't come to the market. So that's what makes it more challenging for us to, and for some markets, to assess the risk in sort of a quantitative way. So the solution to that is to consider what data insights that you have, and Advantage, and a lot of the insurance in this space, we have access to leading data resources to really, understand, what the risks are in terms of expropriation, currency convertibility, what have you, or non-payment risk. The second is marrying the actuarial science with expert judgment. So expert underwriting. People or underwriters who have decades of experience, case with Vantage and other markets as well, to really get in on the ground and understand what the risk is and what the likelihood of a challenge is. Now, in the context of Latin America, I do think that it's a unique region, obviously, but some lessons that we've seen elsewhere are relevant. So diversification. So as Alexandra said, it's a heterogeneous region. There's a lot of differences in there. But that's also a benefit as well because, proverbially, don't put all your eggs in one basket. Be diverse in terms of geography, be diverse in terms of, asset class, be diverse in terms of obligor you're exposed to. And then, the second part is work with partners who have experience in the region. So that's why we like working and reinsuring multilaterals, export credit agencies, the DFIs of the world, because not only do they have expertise on the ground in the region, but also these partners have preferred creditor status, and that can oftentimes enhance the credit profile of the underlying transaction, and give it a halo effect, if you will. So that's that's been our approach and that's been our strategy, but I really want to underscore the purpose of the product to enable and promote trade and investment in emerging markets.
Now, that's a great segue to sort of bat this over to Daniel. So based on your experience at the Tax Foundation and your legislative work in the U.S. Senate, how do you evaluate the effectiveness of current tax policies in attracting foreign investment? And then what reforms would you recommend to enhance their competitiveness?
Thanks for the question. So at Tax Foundation, one of the things that we really care about is the tax base. So a lot of times when you see headlines, you see things about the rates. A country might be increasing its tax rate like the UK recently did from 19 to 25%. The US reduced its corporate tax rate from 35 to 21 back in 2017. But what matters long term is what is being taxed. How do we define, especially on the business side, business income? And one of the things that we look at, especially in the US context, and I think it's particularly important for Latin America, is when policymakers are designing a kind of neutral, transparent approach to taxing corporate income versus something that requires a much higher corporate tax rate, and then you're giving away things through special preferences or subsidies and all sorts of things of that nature. So in the US, we've seen a little bit of both. So a lot of what happened in 2017 was reducing the corporate tax rate and aligning the corporate tax base in a way that it supports business investment and CapEx. There's a bill going through Congress right now that supports R&D investment. But in the South American context, in Latin America, we see a lot of countries where there are relatively high corporate tax rates and a lot of subsidies or giveaways or different incentive packages that kind of muddy the waters a bit on what the policy approach really is. And worldwide, the average corporate tax rate is in the low 20s. In Latin America, It's closer to 30. You have countries with rates above 30, 35% in Argentina and Colombia, 30% in Mexico. And what a lot of times countries are doing is they're trying to think of ways that they can, in spite of having a high corporate tax rate, provide support for foreign direct investment. But at the same time, that puts a lot of weight on economic development agencies to make deals or figure out ways to channel funds to different investors, when if you had lower corporate rates and a right-sized corporate tax base, it would be more attractive generally, more competitive generally, and you don't have to micromanage all these inbound investments. Latin America has been doing fantastic on foreign direct investment, over $200 billion in 2022. I think 4% of Latin GDP and FDI. And what has been talked about this morning, this pivoting from China or the nearshoring or reshoring of supply chains, has come to benefit. But there are other forces at work. I think we'll talk about the global minimum tax in a minute that has some key features that will impact the way countries are thinking about their corporate taxes and inbound investment.
No, I appreciate that. So let's pivot a little bit to navigating challenges in governance and policy. So I'm going to, sort of give this to Alexandra. Everyone's favorite topic, ESG. So what is the state of environmental, social corporate governance, or ESG, right now in the U.S. and around the world?
Yeah, so I am the general counsel at Strive, and I am going to put my corporate shill hat on here. We were founded 2 years ago with the sort of surprisingly sexy and controversial take that your investment dollars should really just make you more investment dollars, right? And so if you are interested in changing the world in any number of directions, there are a number of charities and other places to give. And your 401k is probably not the best. And so this has, I think, really changed the conversation, where maybe in 2018, 2019, most people hadn't heard of ESG, had no idea all of the social causes that their investment dollars were being used towards. And from 2020, 2021, 22, I think that conversation has really shifted. And what we've seen is that when people hear about ESG, they maybe feel any number of ways about the sort of substance of the policies. ESG stands for environmental, social, and governance factors that tend to affect investments. But they don't usually want it happening in their portfolios. And so what we saw actually really recently last month at Davos was that ESG isn't exactly in retreat, but it's going underground. And so over the last few years, you had seen a rise in ESG metrics being used for really substantive rewards and disincentives. So individual account managers were being rewarded for putting money into ESG-focused funds. Boards and executives were being compensated based on the sort of visual diversity of their board makeup, some of these other factors. And what we've seen now is ESG is sort of a dirty word, but a lot of companies are still interested in doing the activity, and I think there are kind of broader reasons for that. So when we look around the world, I think that ESG is part of kind of what I would call an elite, but on the decline worldview. And so it has been important to kind of kiss that ring historically. And I think some of the movement that we're seeing, again, Milei in Argentina is a great example, that perhaps that ring kissing isn't quite as important as it used to be. And in fact, maybe the Overton window is expanding. And so while Western Europe has been a really elite power center, perhaps that power is on the decline.
So along that vein, Daniel, I'll pose this question, or the next question rather, to you. How do you see the tax policies in Latin America evolving in response to global trends like the OECD, that tax framework? Like, how do you see the tax policies in Latin America evolving?
So let me poll the audience real fast. Who has heard of the global minimum tax? Okay, a decent amount of you. So a couple of years ago, nearly 140 countries negotiated this new regime on taxing corporate income. Most of the time, countries determine their own tax rates, their own tax base, and they have tax law. And then if you're an investor and you're paying attention to a financial performance of a company, you're paying attention to their financial statement income. The global minimum tax says we're going to borrow concepts from financial statement income. We're going to create this new bespoke tax base that everybody's kind of going to agree on. And then we're going to apply a 15% effective rate to that new tax base. Now, the first question I get a lot of times when folks ask about the global minimum tax is how does this thing get enforced? Well, there's 3 sets of rules, and they're interlocking. There's a rule for domestic companies, there's a rule for outbound companies, and there's a rule for inbound companies. And if you're a country that has a lot of very powerful companies or companies that are doing a lot of business around the world, and you embrace all 3 of these rules, and you have a lot of inbound work, you can essentially tax a lot of corporate income, whether it's sourced in your jurisdiction or not. It's really kind of a very, I would say, nefarious design that I certainly don't agree with on principle, but it is something that more than 30 countries are moving towards adopting. The inbound rule is kind of the real hammer, but that doesn't really come into effect for most jurisdictions until after 2026. So when we're thinking about what trends might be happening that could affect tax policies in Latin America, it's those rules that should be leading policymakers to think through, okay, let's think about it in this a couple of directions. If you're a Latin American country with a relatively high corporate tax rate and this new global minimum is at 15, well, you're automatically you're an outlier country relative to the new minimum. So you may think of, okay, maybe we can reduce rates towards the minimum. Secondly, the base, as I mentioned earlier, really matters. And the different tax subsidies that a lot of governments give out reduce effective tax rates, and they may be reducing effective tax rates below that minimum. So a lot of inbound companies or attractive things governments might want to do to create inbound investment may just be scooped up by another government applying the global minimum tax. So you have to think through what incentives you have. There's a narrow path that I see for governments that are interested in being competitive and retaining some authority over their corporate tax rules in this context, where you might want to lower your corporate tax rate and then design your tax base around essentially corporate cash flow. So you're allowing businesses to use their retained earnings to invest and not necessarily triggering the corporate minimum tax because of the way the different financial statement and tax rules interact. So that's one big thing, and especially true for Latin America and jurisdictions that have a lot of inbound FDI from Europe, because Europe is leading the charge on enforcing these rules. The US has had a minimum tax for several years, but it doesn't quite line up with the new rules, but that's, I could talk for another hour on that. But I'll leave it there.
Thank you, Daniel. So Ryan, same question, right? So political, risk insurance, how is it evolving? And then if you can sprinkle in or pepper in a little bit about Russia and Ukraine, that would be great.
I won't sprinkle in. I'll start with Russia, Ukraine. So it's speaking about claims from Russia, Ukraine. So one thing I'll say is that, yes, that has been devastating for investors in that market. The question is, those losses, have they transpired into claims? And what we found is that a lot of cases, it was just not insurable, or those risks were not insured. And the market has historically been quite cautious of Russia, Ukraine, because it's historically been a risky region, and wasn't, so even before the incursion in last year, there was some caution there. So again, we have seen political violence claims in Ukraine, and there have been reports of some investors having difficulty, converting their dividends into local currency due to capital controls implemented by the Russian government. But it has not been a cataclysm of claims in that sense. Pivoting to Latin America and just more broadly risks here in the region and elsewhere. Obviously we've heard today about saber rattling between Venezuela and Guyana, but in terms of claims in the market, we did see political violence claims in 2019, and historically stable markets like Chile. And then Brazil as well. There was unrest there, which sort of had an impact. I don't want to. It does seem like there's a lot of risk, but the flip side to that is that it does increase the relevance and the importance of the product, the political risk and credit insurance product. And for that reason, we've seen a lot of growth in the market and a lot of, more reinforcing the purpose of the product, which is just, as I said, to support trade and investment. So, there's a statistic that, their market is expected to grow by 60% between now and 2027. In terms of what emerging risks we're focusing on or we're looking at in the region, I want to highlight one, which is concept of resource nationalism. So it's no secret that in Latin America it's rich in important domestic critical resources. So copper mines and grain and what have you. And governments know that. And one thing that we've noticed is there's been increasing propensity for governments to put or to increase regulations that may, for all intents and purposes, expropriate an investor's asset. Topical example of this now is First Quantum in Panama. So Canadian operator of mines, they have a copper mine in Panama. There was a years-long dispute over that contract and dispute over royalties that they were expected to pay to the Panamanian government. In December, the Panamanian government just canceled ordered the mine to shut down. And so that is an expropriation risk that we're monitoring, but our worry is, does that sort of permeate elsewhere in the region? And that's something that we're focused on and sort of an emerging risk in the sector.
No, that's good. Let's sort of pivot to our last sort of broad topic, which is exploring future trends and the risks in Latin America's economic landscape. So this question is to Alexandra. So with the recent approval of everyone's second favorite topic, Bitcoin, as if we haven't seen enough documentaries, right? With the recent approval of Bitcoin spot EFTs by the SEC, what is your perspective on the adoption and impact of cryptocurrencies?
Yeah, so before Strive, I was at a Bitcoin company for 2.5 years. So I will just start. I am pretty bullish on it. And I think what we've seen in Latin America specifically is that in recent memory, you sort of had two currency options. One was a local currency that oftentimes was subject to rapid and dramatic inflation. The second was to be a dollarized economy and to use the US dollar. And if you it sounds good, and then you zoom out and you think about having fiat currency controlled by somebody else's central bank trying to micro-tune somebody else's economy, it's the ultimate passive recipient position, especially with respect to your own currency. And so a few years ago, what Bukele did in El Salvador is he opened up a third option, Bitcoin. And he took a lot of heat for it. There was some temporary loss, especially during the prolonged bear market, but he made Bitcoin legal tender. The US dollar remains quite popular and more common in El Salvador, but you can buy and sell in Bitcoin in El Salvador. And so with the Bitcoin ETFs, spot ETFs finally getting approved, what you see now is way more investors who are going to be able to invest or at least get some exposure to Bitcoin through the same accounts they use for all their other investments. You don't have to go to Coinbase. You don't have to go to River, anywhere else. You can do it kind of all in a one-stop shop. And so I tend to think that this is going to lead to increased demand for Bitcoin. And this spring, we're actually on track for a halving event where the amount of Bitcoin you get for successfully mining gets cut in half. And so typically that's associated with a bull run. And so while a lot of this spot ETF stuff I think has been baked in, and in fact there were a lot of redemptions, particularly out of the Grayscale Trust, I tend to think that this is going to do good things for the Bitcoin price. It's going to be elevated and perhaps stay elevated. And so I think it might really reward El Salvador's ingenuity and risk-taking and make Bitcoin a much more viable currency for Latin America as a go-forward option.
No, I appreciate that. So Daniel, let's talk a little bit about more about OECD. So can you elaborate on the implications of the Yellen OECD global minimum corporate tax for multinational companies?
Yeah, so as I was describing earlier, this is an effort that Europe is at the vanguard of as far as implementing. The OECD and the IMF have looked at this proposal and they say, this could increase corporate tax revenues significantly. maybe up to 9% increase in corporate tax revenue worldwide. What we've been monitoring, however, is the countries that are actually adopting these rules, what their official revenue scorekeepers are saying. And it's commonly much closer to about 3% increase in corporate tax revenue. So one of the things that we're thinking through is, like, as you adopt something that's as complex and difficult to enforce as a global minimum tax, like, what's the trade-off that you're making as a policymaker? Is the revenue actually going to be there, or are you just hamstringing all of your ability to use corporate tax in different ways to support investment or inbound investment? And I think that's one of the real challenges here. I wrote a piece not too long ago using the children's tale of the Emperor's New Clothes to describe what we're seeing with the global minimum tax. But in some ways, it's here to stay, because a lot of countries have already put this into law. And the question is, okay, well, what are the workarounds that either companies or governments are going to figure out? I think for the U.S., there's a real question in this election year of what things look like for our tax policy post 2025. It's potentially a $6 trillion swing in corporate tax revenue, or in tax revenue generally, depending on whether it's a democratically controlled White House and Congress versus a Republican controlled White House and Congress. And there's all sorts of variations in between. But it's a big year for tax policy in the U.S., and we're not really sure who is going to be a leading voice from the political side to look for opportunities. Obviously, President Trump is very protectionist and interested in very high tariffs on our trading partners. That would be harmful for U.S. economic growth, and I think be a drag on world economic growth. And then on the other side, the Biden administration and their budgets are interested in whatever corporate tax hikes they can get through Congress. So I think right now, thinking about the impact that global minimum tax has is really pushing lawmakers worldwide into a different lane of thinking than they had previously about competitiveness and about where they get revenue. And it's really going to be a challenge for the business community and the policy community to think through what a stable landscape looks like over the next few years.
That's good. So Ryan is going to bring us home. And I don't know where Francisco is, but I get cool points for keeping us within time. So last question to Ryan. In the context of Latin America, what are the key political risks currently influencing business decisions? And could you provide an example or examples where political risk and credit insurance could be particularly useful in the region?
Yeah, so I'll two key things. So there's the topical risks, which are inflation in the region, political violence, talk about Chile, Brazil, but now Ecuador being more topical, and then also a lot of uncertainty around several elections in the region. But then there are the fundamental risks, the risks that are, if not in the background, but always top of mind for investors. So confiscation, expropriation, nationalization, deprivation, capital transfer risks that really are top of mind. But there's also a lot of great opportunities in the region, and these are also great opportunities which I think are well suited to be married with the credit insurance product. So one thing that I think is particularly relevant in the region, but also makes we've had partnerships before, and there's been partnerships in the market, has been supporting transition to net zero, renewable energy projects. So these are project finance like transactions. So the underlying is wind farm or solar farm or what have you. The risk there is that since these are longer term projects, oftentimes over more than a decade of the financing will take place, will be in place. There could be a risk that a change in government occurs, and then the contract is nullified, or there's something done to slash returns or expected returns to investors. So the credit insurance product for project finance is particularly relevant because it can mitigate those risks. And also a unique feature of this product is that these are not annually renewable policies. They're bespoke policies drafted for the specific product or specific project. So in that case, if you have a 15-year tenor, or your underlying loan tenor is 15 to 20 years, the market can support those. We at Vantage, we offer tenors for project finance of up to 15 to 20 years and $50 million of gross limits. That's meaningful capacity which can support important investments such as those in project finance or renewable space. And also I think that those investments are a little bit more recession-proof because there's a very strategic and important critical infrastructure need.
Thank you. All right, so Ryan Whiting, Vantage Risk, Daniel Bunn, Tax Foundation, Alexandra Gazer with Strive. Give them a round of applause.